Hi there, Sam Redlick here for Sam Redlick Law. Today I'm going to be answering the question, what is a limited liability company or LLC? And getting right to it, a limited liability company, it's a relatively new form of business organization. It's created by state statute and it's grown rather quickly in popularity across the states over the last several years. In LLC, it's often referred to as a hybrid entity because when properly structured, it combines the protection from liability that is generally associated with a corporation with the pass-through federal tax treatment of a partnership. Now, while the owners of an LLC, who are referred to as members, have no personal liability with respect to the obligations of the LLC, their individual acts and or omissions related to the LLC are subject to personal liability, and this is also the case with the directors and officers of a corporation. For pass-through federal tax purposes, an LLC is treated like a partnership or sole proprietorship with income taxable only to its members. At the same time, each member of the LLC is treated like a shareholder of an S corporation and carries limited liability for the debts of the LLC or the claims made against it. The main benefit of the LLC, without question, is its flexibility in how it can be organized and operated. The LLC does not suffer from the same restrictions on ownership that a Subchapter S corporation is subject to. An LLC can have as few as or as many members as it chooses. Interests in an LLC can be held by any type of person or entity, and this includes partnerships, corporations, non-resident aliens, pension plans, trusts, and even charitable organizations. Also, another benefit is that special allocations are permissible with the LLC, therefore eliminating any single class of stock requirement. And because the LLC may own over 80% of the stock of a corporation, it's free to become a member of an affiliated group, and so that's also an interesting benefit. As far as how LLC members gain their ownership, this is done by making what's called a capital contribution to the company. This capital contribution can be in the form of money, equipment, or future service, also known as sweat equity. Basically anything of value, or most things of value at least. Now, if the capital contribution is not money, then it is typically assigned an agreed upon value by the members. The proportion of the ownership allocated to each member, which is referred to as their membership interest, is generally expressed in terms of a percentage. For the most part, the percentage of membership interests also controls the distribution ratio that attaches to the profits and losses as well. With respect to the management, the day-to-day activities of an LLC, they are handled by what's called managers. A manager may be one member. It could be all of the LLC members. It could be some of the LLC members. It can even be a person or an organization that is not have any ownership interest whatsoever. Now, in cases where a non-member is the manager and they are running the operation, their compensation is tailored. Well, it can be tailored in any number of ways. And of course, when best practices are followed, this should be memorialized in what's called a management agreement. It's important to know, however, most importantly, that these non-member managers will not, however, share in any of the profits and losses of the LLC. From a tax perspective, an LLC is taxed as a partnership, and thus, unlike a Subchapter S corporation, the amount of deductible losses is not limited to the total of the shareholder basis in their stock and shareholder loans to the corporation. As with a partnership, the LLC member can deduct losses up to the total of the basis in the partnership interest, the share of partnership income allocated, and the allocated proportion of qualifying debt. Losses that are suffered may then be used by the individual members to offset any other sources of income. And that's what an LLC is.